The U.S. central bank has held its key interest rate at its current 22-year high as it seeks to stabilize price rises, which had recently reached near-record levels. What is the U.S. Federal Reserve? Over the past decade, the Fed kept interest rates low while it deployed trillions of dollars in stimulus and expanded its regulatory oversight. Now, the central bank is back in the spotlight for its battle against inflation. The Federal Reserve is the most powerful economic institution in the United States. It is responsible for managing monetary policy and regulating the financial system. Today, the Fed is tasked with managing U.S. monetary policy, regulating bank holding companies and other member banks, and monitoring systemic risk in the financial system. The seven-member Board of Governors, the system's seat of power, is based in Washington, D.C., and currently led by Fed Chair Jerome Powell. Each member is appointed by the president. Historically, the Fed has been driven by a dual mandate. First, to maintain stable prices, and second, to achieve full employment. The Federal Reserve's rate target remains at 5.25% to 5.5%. The Federal Reserve on Wednesday again held benchmark interest rates steady amid a backdrop of a growing economy and labor market and inflation that is still well above the central bank's target. Fed Chair Jerome Powell said the situation remains something of a riddle, with U.S. central bank officials willing to raise rates again if progress on inflation stalls. Wary that a rise in market-based interest rates may begin to weigh on the economy in a significant way, and trying not to disrupt, any more than necessary, an ongoing dynamic of steady job and wage growth. The bank has been raising borrowing costs with the hope of cooling the economy and slowing inflation, the rate at which prices rise. It comes after recent data showed the U.S. economy grew faster than expected. Raising interest rates is one mechanism that central banks can use to tackle inflation. The theory is that by raising interest rates and making it more expensive to borrow, consumers will spend less, and that would lead to slower price rises. The bank had faced criticism, with some suggesting that holding interest rates at higher levels could put the U.S. economy at risk of entering a recession. What happens when the Fed raises rates? When the Fed raises the federal funds target rate, the goal is to increase the cost of credit throughout the economy. Higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments. The Fed funds rate impacts how much commercial banks charge each other for short-term loans. A higher rate means more expensive borrowing costs, which can reduce demand among banks and other financial institutions to borrow money. What happens on stocks respond immediately to Fed rate hikes. Higher market interest rates can have a negative impact on the stock market. When Fed rate hikes make borrowing money more expensive, the cost of doing business rises for public and private companies. Over time, higher costs and less business could mean lower revenues and earnings for public firms, potentially impacting their growth rate and their stock values. What happens on bond market? Bonds are particularly sensitive to interest rate changes. When the Fed increases rates, the market prices of existing bonds immediately decline. That's because new bonds will soon be coming onto the market offering investors higher interest rate payments. To reflect the higher overall rates, existing bonds will decline in price to make their comparatively lower interest rate payments more appealing to investors.